if you had told me in November of 2022, around the week that FTX had gone bust, that 2 years later, less than 2 years later, a year and a half later, honestly, Bitcoin would be essentially fully institutionalized with ETFs, with almost every custodian on Wall Street offering some type of allocation to it for their clients, I would have been stunned by that. I would have thought that cryptocurrency would have been dead for right after the FTX debacle, because of everything that I thought from 2019, even earlier, till 2022 about cryptocurrency. All of the issues that I saw with it, I thought it was all vindicated by what happened with FTX, and I could not have been more wrong. And for the first time in our whole life, we bought some exposure to cryptocurrency, specifically IBIT, the Bitcoin ETF by BlackRock. We bought it right after it launched, and it was a very simple stat it was a very simple stat that made me completely switch my opinion about specifically Bitcoin. Well, I'll tell you the stat first. The stat was that there was about 9,000 coins of demand from the ETFs in the first per day on the launch of the Bitcoin ETFs, versus roughly 450 Bitcoin that get mined daily. That was the whole thesis, that there is now there. So Wall Street is a copycat industry, and people tend to copy each other, and institutions, when something is offered in a safe manner, like through something like BlackRock, through an ETF, and their competitors start putting 2, 3, 4% of their equity, of their AUM into Bitcoin, and if that explodes north and someone's fund is up 300 basis points more than their competitor for a year for no other reason other than having that exposure to Bitcoin, it's very hard to justify it to clients. It's very hard to justify not owning that to clients, right? Like the old phrase goes, no one will get fired for owning IBM, right? Well, now this is an institutionalized asset class. This is, whether you like it or not, this is mainstream. This is front page of the Wall Street Journal. The ticker is right there. You see it all the time. This is, you turn on CNBC or Bloomberg and you'll see the Bitcoin price within the first 5 or 6 tickers. It's there. It's not disappearing. And so with this combination of demand and the combination that we thought, look, we could be early here and we could buy only about 5% of our risk, but we did buy 5% of our risk in Bitcoin. We actually reduced some exposure to equities because we think equities and Bitcoin are quite correlated. We don't think of Bitcoin as a risk-off asset. We think of it as a risk-on asset. But in essence, because we were like, if every hedge fund, if every pension, if every endowment wants to just make this 2% of their AUM, right? There's not enough Bitcoin for all of this. And we just saw this as a classic commodity squeeze. Like you can see it in copper. Like it's part of our thesis on gold right now too, that there's just more demand for this stuff in the interim term, and it could change, and our opinion will change if that was to happen. But we just saw way more demand for Bitcoin than possible Bitcoin in circulation that's sold or Bitcoin that's mined. So that's probably the biggest example, I would say, of being really surprised as an asset manager, and also about the most important lesson in our business, which is humility and being humble and accepting that things change and you'll be wrong about a lot of things. And the best time to do something was 20 years ago. The second best time is today. So we are not ashamed. We're not embarrassed of when we are wrong. We try to be the first ones to admit it, because that's the only way to learn. And things change. If things were static, it'd be boring. So we're happy things change.
Yeah. And if other cryptocurrencies, say, became as institutionalized as Bitcoin, would you consider an allocation of those to your portfolio as well?
Well, we would. Well, let me answer the question first. We would consider it, but it would be at the expense of reducing some exposure to Bitcoin again, because it's an asset class. It moves very linearly to one another. So, as an example, adding Ethereum and subtracting some Bitcoin would probably not add any type of benefit to our Sharpe ratio. So I mean, yeah, we would consider it, but it would probably not be such a material thing. And then I think importantly, as an example, spot Ether ETFs just launched, not even close to the same amount of demand. So, and again, if we think of this as a commodity that's experiencing a squeeze, we want to be we'd prefer to be in Bitcoin rather than in Ether. Although Ethereum does have its own benefits, most specifically the smart contracts, Ether's supply is not capped. So it could be an infinite supply in theory, although it would be hard to do because you would have to get the entire Ethereum network or a lot of people on the Ethereum network to agree to it. But it always carries that risk of that commodity, that supply could be produced, and it's very hard to get a supply squeeze in something that you can produce it, right? So that's probably why, like as a thesis, why we would prefer Bitcoin as an investment. And then just as a function of investing, there's just a squeeze happening in Bitcoin that's not happening in Ethereum. If it was, maybe it would be a different answer, but it's not. So.
And how do you know when a squeeze, or I guess when it's the right time to get out of the squeeze?
Well, as an example, we think, that squeezes historically end in two ways. One way is that the price of the commodity goes up so much that it incentivizes the producers to come in and start making more. So, as an example, when oil hit 130, we were actually quite bearish on oil, although we were bullish from 2020 until 2022 on oil. We didn't sell our entire position. We just sold a little bit of it because historically, every time oil goes towards above 120, 125, 130, north of that, producers start coming in and producing a lot of it. And simultaneously, there's demand destruction that occurs because of those high prices. So like one of the best quotes that one of my mentors gave me was that sometimes the cure to high prices is just high prices, right? People will slow down on their discretionary travel. People will not take that trip to Disney with their family that year if flight tickets from New York to Orlando are 80% higher. So, and then that'll push the price down. At the same time, that supply is going up because of all this new production that's coming online, and that's generally so. But I think the challenge with Bitcoin, well, there's two challenges to ending the squeeze, and that new supply cannot be produced. You can only mine 450 Bitcoins per day. So the only way new supply could really happen would be through people selling it more in the open market. And the people that own it have owned it for a very long time. They sound like they want to own it forever, which I think, by the way, could be a mistake. I think that might be investing more with your heart than with your mind. But
I agree.
So in light of the fact that first of all, there is no commodity use for Bitcoin. I mean, it could in theory be used as a form of money. It doesn't seem like it's catching on that much as a form of money. I think it's more for speculation, honestly, than as a form of money. And I could be wrong about that, but as of now, I have nothing to suggest otherwise. And there is just not that. There will not be more production of Bitcoin. So I think what could cause Bitcoin prices to fall down would be a pretty big risk-off event. I also think something that could cause Bitcoin's price to fall down would be if, as an example, if inflation were to resurge and they had to, central banks worldwide had to start raising interest rates again. We saw how Bitcoin behaved. It was the worst performing asset class in 2022 when we had a tightening shock. So that can always happen again. Which again, part of the 1970s was that these things happened often. It was not one and done with the rate hike cycle. It was one stop, big one, finally over. So that's how it went in the 70s in the US and Europe. And we would not be stunned if that were to happen again. So that would be a type of environment where we think we would maybe trim some of our exposure to Bitcoin. But again, it's only a certain percentage of our book. So we don't mind leaving it on because we think the upside, the way we sized it, the upside could be a lot higher than our downside. And especially given the fact that a big percentage of our book is in gold, which is, I guess, one of the theoretical competitors to Bitcoin. If Bitcoin were to collapse, we could see an environment where gold actually benefits from that because, if the digital version of it is struggling, why not go to the hard version of it?